Welcome to Elevate Market Chat. This episode was recorded on June 20th. With the S&P 500 up 15% year to date, Shane and I catch up on the latest rate cuts. We then discuss NVDA, concentrated stock positions, how to begin forming a plan while times are good. We wrap up with a discussion of the latest CBO budget numbers. Thanks for tuning in, and be sure to like, subscribe, and share with others. All right, Shane, here we are again. It's June 20th, and looking at the markets, I think you'd be a little shocked, as would I, that we are sitting here up 15% year to date with the S&P 500. But, we'll probably circle back to this, but equal weight up 4% year to date. So we certainly have a few things to talk about in terms of the overall market and a few data points we've received since then. But how are you doing?
And I'm good. Very busy, but good. Can't complain. Definitely surprised to see the market up as much as it is. For the year-to-date number, even though we did have a nice little pullback of about 6% in April, markets have rallied pretty nicely since then to make some new all-time highs. And so I'm sure what we're going to talk about a bit today is that rational or not, and does it even matter? So I know you've got a few things on your list to chat about, and just looking forward to going through it with you, man.
As am I. So, the first one is everybody's been waiting for the rate cuts. And now you have the European Central Bank. They've done a rate cut. And then you also had the Swiss bank cut rates. And they're on their second cut, which is insane because they're sitting at 1.25%. So that's what it costs for risk-free short-term money. So is this a victory lap? I mean, does this mean, hey, stocks are going to go higher and don't worry? Like, what was your first thought when you heard that news?
Truth be told, I don't really pay a whole lot of attention to global central bank policy. I just focus on what the Fed's doing. So I don't really, I just don't care a whole lot what other countries are doing because I don't really buy a lot of stocks in other countries. A lot of times, if we're going to buy exposure to other countries, we'll do it using an ETF. That's not to say we don't hold any international companies. I mean, Novo Nordisk is a foreign stock. I think it's now the biggest foreign stock in Europe, or the biggest stock in Europe. So foreign to us, not foreign to them. But Novo Nordisk makes weight loss drugs, and so that's been a great position for a while now. So it's not that we never do it. It's just that it doesn't drive a lot of my thinking about economics. I'll tell you one thing though that is obvious is that it's obvious to me, maybe to you as well. But when the United States of America's interest rate, risk-free rate, is substantially higher than the rest of the world, what that generally leads to is a stronger dollar. And a stronger dollar is not good for the United States stock market. It is the opposite of good, actually, because it makes it harder for foreign countries to buy U.S. goods. So, all else equal, if the foreign central banks are lowering rates, which should put pressure on things like euros and pounds and whatnot, that'll put upward pressure on the dollar, and that then translates to lower stock prices in the U.S. And a lot of times commodity prices going down too because they're priced in dollars. So that's the one thing that might have my attention, and it's interesting to see that that might have an impact on U.S. markets, but so far hasn't been the case. Although this stuff just started kind of happening, so time will tell.
Mm-hmm. And it's just interesting with rates that low. It's fun. It kind of makes me think of like Crocodile Dundee, the old movies when there's that scene, I think, and the guy pulls out a knife and tries to hold him up, and it's a Swiss Army knife. And he's like, "Oh, you call that a knife?" It kind of seems
That's
like
not a
that where
knife.
rates are so low. I mean, to even be cutting right now is something else. But when I think about the US, it's just like we have been in this sustained move from 2009 where rates were zero. And now they're finally getting up to kind of a normal level. To think that it's good for the economy now to move to a stimulative approach by lowering rates, and then that's the start of a new bull run or positive move in the stocks. I just don't see that as being a long-term thing. And I'm not trying to call a top here, but does that sound like the healthy news that you want, where now rates or stocks ready to go? Or I think personally, I'd like to see rates hang out around 5% for a sustained period, see strength in the stock market. I think to me that would be a lot more of a positive signal.
Well, yeah, I mean, history is very clear that the first rate cut is usually correlates to the beginning of a bear market or a major drawdown. So, I mean, I've been writing about this for a year and a half, so it's kind of not that interesting for me to even really bother talking about anymore. But I've said many times and many commentaries that there wasn't going to be a cut coming unless there was a major drop in stock prices and a major downturn in the economy with a recession and rising unemployment. I mean, that's what's going to get you your rate cut. So when they say, "Oh yeah, we're going to cut rates by the end of the year," what you should hear is that, "Oh, we expect a recession and a bear market and rising unemployment by the end of the year." Not you should buy stocks, right? So I think
Mhm.
that's the major disconnect that we see in markets today. And that's from the retail investor right up on through to the investment analysts at major investment banks. I just think people aren't listening and they're not paying attention to history. Um, and that's part of the reason that the market keeps going up, despite the fact that the valuations don't warrant it, because they're not paying attention to that either. This is just a kind of a passive investing bubble that will go on for as long as it can go on. And when it stops, I mean, look out below. Like right now, NVIDIA and Apple and Microsoft make up 20% of the S&P 500, and they're all crazy overvalued, like crazy. Microsoft's like the cheapest of them, I think, but they're all way above our buy up to price. We can't. I can't. I mean, I don't know. I can't in good faith buy these stocks at these prices, despite the
Mhm.
fact that they might continue to go higher. I mean, we own plenty of them. We'll hold on to them. We're not exiting those positions just because they're overvalued. But I think the long-term returns for people who are paying these prices for stocks like that, I think they'll be disappointed 5 years from now, and they'll say, "Well, geez, I'm flat on my Nvidia purchase." Which would be
Right.
a good thing. I mean, because they could easily be down 50%. Nvidia, don't forget, was down like 70% in 2022. So Nvidia can go down 70%. We'll get this. If Nvidia, I mean just Nvidia at 7% roughly of the S&P 500, if that thing drops 50%, it's going to drag the whole market down with it. Period. I mean, all the other stocks will need to be up while Nvidia is going down in order to kind of cover that bogey. And it probably won't happen that way. If Nvidia is going down, probably all the other semiconductors are going down, and you know, it, when you have that, like the S&P 500 isn't even diversified really anymore. Arguably, it's more concentrated than it's ever been. And I don't know. Yeah, I mean, you said it earlier. The equal weight's only up 4% for the year.
Mhm.
Um, and the Russell, I don't know. I was just looking earlier, but the Russell 2000, I think, is down. Is it down for the year? I don't know. It's not. It's not good. Whatever it is, I can tell you, it's not good, and it hasn't put in a new high since it's 2021. Yeah,
Right.
the Russell 2000 is currently down 2.24% for the year.
Mhm.
So what's that tell you? 2000 stocks are down, three stocks are up a lot.
Yeah. And it's frustrating because the reason why we talk about the equal weight, right, is because it gives just representation of an even 500 stocks. Just how
Yeah,
are they all moving?
right.
And what it's telling you is that in the market cap weighted or the S&P 500 that everyone tends to think about is that you have a few companies that are driving the lion's share of this move. So do you want to have a diversified portfolio that only includes, five stocks? That's that's a hard bargain when you start talking about risk management. And I
Well,
think
it'll
that's
work for as long as it works, and then once it
mhm,
doesn't work anymore, you better like if you're gonna do that, you better know how you're getting out. That's all I know, because it'll work for as long. Like if you had done this at the beginning of the year, if you had put a third of your money into Nvidia, a third of your money into Microsoft, and a third even into Apple, which isn't isn't up as much as some other stocks this year. But if you just put 30% in each of those, you'd be very happy with your returns. Like you'd be up way more than the 15% of the S&P 500.
Right.
Way more, right? But on the way down, you will lose a whole lot more too, unless you know exactly where you're getting out. And if you have your stop too tight, you would have already stopped out of NVIDIA a couple times. NVIDIA's gone down 20% once already this year.
Hmm.
I'm pretty sure. Is that, I don't want to say, let's see, NVIDIA from March 8th to April 19th was down 21.77%. So, if you put 30% of your money on that, would you have been able to stomach that drawdown? Where would you have put your stop? If you put your stop at 20%, you were out and you did not experience the most recent run from the split adjusted $76 a share to 140 where it was this morning before it started crashing.
Right.
That was an 82%. So NVIDIA's up 82% since April 19th, as of this morning.
That's unbelievable.
It's ridiculous, Can you imagine having 30% of your investable assets in something like that and then trying not to get stopped out? I mean, where do you put your stop?
Yeah.
In this case, you could have put it at 25% and you would have still been in for this. But holy moly, looking at your statement during the course of that March to April move, you would have been down quite a bit. And for what it's worth, NVIDIA also dropped from February 12th to February 21st. It dropped 11.21%. So, I mean, we've got a 10% correction and a 20% bear market for NVIDIA this year. And the stock has gone from a split adjusted $48 a share to a high of $140 a share, up 186% as of this morning. And I keep saying it, so I'll just tell you, NVIDIA is down from its $140 a share, 141 actually, it reached overnight. And as we're talking right now, is down 8.06% just today, trading at 129.52. So, I mean, you want to put 30% of your money in that? I don't.
Yeah, and that's the challenge. It's really easy to look at it in hindsight and think, "Oh, I should have bought that. Look how much it's up." But having the ability to allocate the appropriate amount of capital, stomach some of that volatility and remain in the position, and then scale out at the appropriate time, yeah, that's a bit of an art. It's just not that easy.
A bit of an art. It's a bit of a gamble, is what it is. And don't get me
Yeah.
wrong, I would love to have 30% of my money in NVIDIA on the days where it's going up 8% a day. So I'm not an idiot, I would
Hmm.
love to have the upside, but the risk that comes with it, I'm not so sure that would work for me, and maybe I'm more conservative than some other people out there. That's okay. But yeah, I just don't think I don't think that's the play. Although I know we're a little probably off topic from what you originally planned to talk about on this call today, but I can't help but bring up an inquiry we got from a client that started working with us in late 2021. I think it was August or September maybe of 2021, and he's been pretty conservative. Call it like a balanced portfolio, maybe half in our capital strategy and half in our low volatility strategy. And it's not exactly the same as like a 50-50 stock to bond portfolio. But he asked a question. It's like, hey, my account doesn't really feel like it's going anywhere. I'm like basically, I'm up a little bit since late 2021. But my account's mostly flat, and I look at the S&P 500, it's up 20%. And say this is $1 million account. The guy's like, it cost me $200,000 to be invested with you guys instead of invested in the S&P 500. And I mean, gosh, that's it's true. But the idea that somebody's going to put $1 million in the S&P 500 in late 2021 and still be holding it all today, right? Without having sold any of it during 2022 when the index was down like 30%, because your $1 million has turned into 700,000 by October of 2022, right? So do you have the stomach for that kind of volatility? I don't know. And And today, right, if you had held through all that and just kind of went to sleep for the past couple of years, didn't look at any statements, didn't watch any CNBC, didn't open the Wall Street Journal, maybe you do just, put $1 million in the SPY fund in August of 2021, and then wake up in June of 2024 and you're up 20%, but you don't see all the volatility in between, right? So if that were how it worked, then great. It could have just as easily worked the opposite way, right? Where you're
Right.
down 20%. And it's amazing to me that if you go back and look, I just did a little bit of analysis. If you had put 50% of your money, which is more likely for like a balanced type investor, you probably any other investment company in the world, you go in and you do your risk assessment and you work with the advisor, and they're going to recommend to you. They're not going to recommend to you 100% SPY. And if they did, you should fire them because that's not worth paying for. You can do that on your own for 4 basis points. There's no need to pay somebody a management fee to buy 100% SPY, right?
Right.
So if that's what you want to do it yourself. But if you had gone into a investment management company and said, "Hey, I'm a balanced investor and I got $1 million," what they would have done is put you in a pie chart that's 50-50 or 60-40, whatever, stock to bonds. Well, I just looked at 50-50. So since August 2021, if you put 50% of your money in SPY, the S&P 500, and then 50% of your money in AGG, the aggregate bond index, you would be up right now, not 20%, you would be up 2.5%. And a
Not the most
50-50.
impressive return.
No, it's terrible. I mean, we're talking about almost 3 years, and 2.5% return is really all you got on the 50-50 strategy because the bonds are down 16%
Hmm.
since August of 2021. Now get this, Kyle. How much do you think you're up if you use the S&P 500 equal weight instead of the SPY? Same 50-50 breakdown. So 50% equal weight and 50% AGG.
From then maybe what 40, 50% the
Nope.
total return over all those years. Okay.
No, 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 no. It's worse than 2.5%.
Oh wow.
It's so if you had put 50% of your money into the equal weight index in August of 2021 and 50% of your money into the AGG, you would be down 5.5% today. The S&P 500 equal weight is up exactly 5% since August of 2021. And
That's some
AGG is down 16% since August of 2021. 50-50 portfolio is down 5.5%. And that's before paying your investment management fee.
yeah.
So don't pay an advisor for something like that.
That certainly turned into a diversification model,
Yeah,
not
right.
diversification. And
Yep.
so here's the interesting thing, Shane, and I was having a conversation about this recently, and I think we'll probably have more of these. Some people did buy the, select few that have moved up, and right now they're like, this is great. I never had to hire anyone, and my portfolio has gone up tremendously. Well, there has been no crash or anything. So then how do you look at that here where now let's say you're 40 to 60, anywhere in there, and the head in the sand model worked great, but now we're here. How do we start thinking of putting a plan together so that we don't go back down with everything if it were to happen like that? Or just how do you think about, kind of that concentrated stock positioning?
Yeah, well, I mean, a concentrated position is not a problem in and of itself. I think a lot of the wealthiest people in the world got that way because their business that they operated was their biggest holding, and they never sold any of it, until it was time to retire. And so those concentrated positions are what have made a lot of people really, really wealthy. They've also ended a lot of people's retirement by, like people who were concentrated in Enron stock right before it went to zero, and all the other horror stories, Tyco and so on. I mean, those are just they exist. There are a lot of them out there. So I don't personally have a big problem with concentrated stock positions as long as people have the right exit strategy.
Hmm.
And it depends on how much volatility you can handle and how confident you are in what you own. Um, and the major key is whether or not you are currently taking distributions from your portfolio. If you're taking distributions and your portfolio is designed to provide you income during retirement, you have the sequence of returns risk that is totally out of your control. If you're just, if you're young and you're going to be working for another 10 or 15 or 20 years or even 5 years, well, then you've got time to ride it out, right? But if you're actively taking income from your portfolio, and say 30 or 40 or 50% of your portfolio drops by 50%, and you still need to take this year's income out of it, well, you're now a forced seller of a stock that's in a major drawdown. And the only other thing you could do is take your income from all the other stocks that aren't going down, but that's just going to increase the concentration of your remaining portfolio, right? So
Right.
it's there's no good way out of it. Once you start taking income and you're no longer pumping money into your investment account, but rather you're on the other side, right? And you're taking the money out. I think that's where concentrated positions can become a really big problem. Like I said, it's all fun and games while stocks going up. It's just like musical chairs. While the music's playing, you got to keep dancing. And
Hmm.
unfortunately, the music always stops at some point. So how if it feels today a lot like 2021 when AMC and GameStop, which are bankrupt companies fundamentally, were the biggest gainers in the S&P, or not in the S&P 500, but in the whole stock market. And those companies still haven't gone bankrupt. It's 3 years later, and they still keep getting people to buy their stock. They're still selling new stock and convertible bonds. I don't know who's buying this crap. I'm certainly not. Um, but people are, and so I wouldn't want to own GameStop. It pretty much went round trip, right? It went from $10 to $200 or whatever it did, and then back to $10 pretty recently. So um, it feels like that kind of a market where just nobody's paying attention to what the economy is telling them, what the Federal Reserve is telling them, what the data is telling them, and everybody's just kind of happily just well, keep buying stocks, and everything will be okay in the long run. But 2021 ended, and then we were in 2022, which turned into a nasty little bear market. Thankfully, it only lasted a year. But another one of those that could, and I think for a lot of reasons that bear market should have and could have gone on a lot longer. Like if the Federal Reserve didn't start bailing out failing banks and guaranteeing, deposits with no limit from the FDIC, and just, there was a whole lot of government intervention that led to a whole lot more money printing and a whole lot more debt in the system. So it's just a matter of time before that stuff catches up with us. And the only question then is, does the government just print more money, to try and get us out of that next problem? And ultimately, how long can they do that for
Right.
before the rest of the world says, you know what, we're not buying your debt anymore, and we lose our ability to just print ourselves out of problems, which solves the problem in the short run, but makes the problem bigger in the long run. So I know I just talked for a while, but that's kind of where I see us right now. And ultimately, the only responsible thing you can do in a bubble, which I'm not afraid to call this a bubble. Um, the only responsible thing to do is buy things and hold them with a trailing stop. That's what you do. So that's
Yeah.
what we do.
And that's the big one here is trying to predict markets. That's definitely not an easy task. But if the trend's up, now is the time, like nobody's freaking out just yet. So this is a great time to think about what steps you are going to take in managing a portfolio. So what are those levels where you're out? Because making that decision now is much easier and better than waiting for a big pullback in the markets and your emotions just run wild. Um, and if you look under the surface, I mean, Shane, you shared these numbers. So I'll just kind of read a few of them off. We can talk about it. But the CBO, they predicted kind of what the budget deficit is going to look like. And notice that's not a surplus, which you would hope to be having in this period. I mean, we're not in a war or anything, but a deficit of 1.9 trillion for this year. Debt to GDP ratio, 6.7%. and that's up from 5.3% in February. Deficits exceeding 5.5% of GDP every year from this year to 2034, so 10 years. And then, hey, why not bump inflation up 2.7%, up from the original expectation 2.1? So, man, I see this, and I know Stanley Druckenmiller had talked about before, but it looks like the government is in a war right now, the way they're spending. So it scares me. So then, well, what if we are in a hard time? What's left? Um, Shane, what was it like when you read this, and maybe some of your I don't know if it even changed what you were already thinking, but I'm sure your jaw dropped a little bit, as did mine.
Yeah, and for anybody who doesn't know, the CBO is the nonpartisan Congressional Budget Office. They put out forecasts related to, I guess, just the financial state of the country. And it's just amazing to me how any economist can run around and say that, where the economy is strong and consumers are strong. And I mean, if it were strong, we would not be running these kinds of deficits. We wouldn't have to be printing money that we don't have and borrowing at rates that we can't ever afford to pay back. And make no mistake, the $34 trillion or whatever the national debt is today will never be paid back in today's dollar terms. Um, like the only way to pay that money back is to print $34 trillion because we have a deficit, not a surplus. There's no, if people ran their household this way, they would be bankrupt and starving. And that's what's ahead for this country. The only question is how long will it take to get there? I think absent a major shift in just government spending. Um, but I mean, and I think you know this, Kyle, because we chatted about it a little bit in our Slack chat as a company when I posted this originally. But I what it really made me think of is just like how are people handling this? And in our economy today, we have what we call a K-shaped economy where the rich get richer and the poor get poorer. So it's like the shape of a K where you have one line extending up and to the right and another line extending down and to the right. And the people who are on the lower part of that K distribution are just not they're not doing well, man. I mean, I posted a screenshot of the number of individuals experiencing chronic homelessness, and it's just going up, 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 up. Uh, and anybody who's been in a major city, that you can see this stuff. You can see the tents. You can see that, like there are actually conversations going on right now in the Supreme Court, I think, as far as like what cities and states can do to prevent people from camping in public spaces because they got to go somewhere and there's not enough shelters for all the people. Like we haven't, I don't remember in my career or even in my like sense of being an adult, like talking so much about the homeless population. It's huge. There's so many people experiencing homelessness and then a whole bunch of kids, poor kids of parents who are just struggling to make ends meet, living in cars and living in parks. And I mean, so yeah, NVIDIA trades at 50 times earnings, but like there are more people without a roof over their head than I think, in a really long time, if not ever before.
Hmm.
So what does that tell you about how great our economy is? And then, it also, um, I was looking at some stats, and I do plan to write about this in the next month or two. But in 2015, 19% of people reported feeling depressed. And lasting hopelessness. And in 2023, that number had grown to 29%. So a 50% increase in people feeling depressed and feeling a lasting hopelessness. And that leads directly to the suicide rate, which I mean, I'm not trying to be morbid, but like these are real issues that real people are experiencing. I mean, we get to sit here and talk about fundamental valuations being extended and other people are trying to figure out like how to feed their children tonight. And so, it's just such a sad state of affairs. Um, And I don't know, I can't solve all those problems. I mean, my job is to analyze stocks and make people money when there's money to be made. So for now, we stay long and we hang on for dear life and mind our stops and tighten our stops as things deteriorate and get scarier and more volatile. But while the market's going up, we just we hold on and we keep moving our stops up with the market.
Yep. And I think that's what we might be looking at. We'll see is just heightened volatility. And as I mentioned before, right now, the smartest thing someone can be doing is forming the plan. Where are those trailing stops? Or speaking with somebody like us that, has been doing this for a while and can maybe help to figure out where those stops should be and manage that concentrated portfolio or just the portfolio at hand. So
I call it mobster investing, by the way. I don't know if I ever told you that, Kyle, but we've all seen the mobster movies where they say things like, don't ever walk into a room you don't know how to walk out of. Well, I don't ever buy a stock that I don't know what my exit strategy is. Like, the best thing you can do to keep the emotional aspect out of it is to determine what your exit strategy is for a stock before you ever click the buy button. Then you're not committed to it. You're not beholden to it. You're not in love with your stock. You know what you're going to do with this thing in an unemotional way before you even find yourself in it. And then you adjust from there, obviously, if things change or, the story changes or markets change, whatever. Certainly you can adjust that. But I would say that, yeah, certainly now, if you don't already have your exit strategy determine it while the market's going up and there's no panic and no sense of fear, because panic is not useful. It's just not a useful human feeling.
And you can always take part of those positions. And right now, short-term treasuries are paying about 5%. So you have something where it's not a zero like it has been before. You can earn something. So
right. And I know we're slightly over time, but there's just a good point that came up earlier today in a conversation I had with traders. It's like, there's a very big difference between taking some profits off the table while something's going up, taking all your profits off the table while something's going up, exiting a position, and shorting a position. Those are four totally different things. So beginning to kind of trim your profits as things go up to nosebleed prices makes a ton of sense. Taking all of your profits when things start dropping below their short-term moving averages makes a lot of sense. Exiting a position, or cutting your position down in half or something when things start dropping below medium-term moving averages makes a lot of sense. Shorting things often doesn't make any sense at all. So stay away from selling short stocks unless you really know what you're doing. But anyway, I think those are, so when people say, hey, I'm going to sell my NVDA, what do they mean? Are they selling their whole position, or are they just taking 10% of their profit off the table? There's a very big difference between those two things. And a lot of times, people don't expand, and people never tell you about their losers, by the way. So you'll hear about their winners, the things they're up on for days, and they'll never be quiet about them. But when they lose 50% on something they're bag holding, they won't tell you about that one.
They won't, and always good to know what they're doing there. And nobody ever went broke by paying themselves. So key things to know. But Shane, with that, I think we've kind of reached our time. And we do have our next market chat. It's coming up July 25th. So we'll have that out for everybody. But with that, I think we can wrap it up. And Shane, thanks again for taking the time, and look forward to seeing you again.
All right, Kyle, always a pleasure. Thanks, man.
Yep. Have a good one.
A big thanks to our audio engineer, Stephen Crowley, for mixing this episode.
This podcast expresses the views of Shane and I as the date indicated and are subject to change without notice. Elevate Capital Advisors has no duty or obligation to update information included. All information is for educational purposes only. Certain information concerning economic trends and performance is based on information from sources deemed to be reliable and has not been independently verified for accuracy. Wherever there exists potential for profit, there's also the risk of loss. This podcast may not be copied, reproduced, posted in whole or in part in any form without prior written consent from Elevate.